Hi everybody, I hope you're well. Look, there's been a bit of news in the last couple of days, today as well, about some two bank failures in the US, and I thought it was a good opportunity to chime in with a little bit of information about this and give you my thoughts and make contact that way, and invite, of course, any questions or correspondence you might have as a result. What I should do first, of course, is give you the old disclaimer, which is that this video contains general advice only, is not specifically tied to your own personal circumstances. If you want personal advice, you need to seek that directly from Solace Financial, from me, without acting on any information in this video. So with that said, I think it's useful to remember to start as well that these two banks that have failed, the Silicon Valley Bank and this morning or overnight the Signature Bank, are pretty niche banks, small banks that have, well, not necessarily small banks, but they have exposures to niche parts of the economy, and that's given way to the thought that the risk of contagion is probably pretty low. I think the other thing that's really important to remember too is that the federal bank in the US has stepped in to reassure market participants, deposit holders with those banks, that their money's safe. And in fact, they put out a fairly clearly worded statement overnight, which I might read a little bit to you from, but particularly, and I'll just bring it up over here, particularly they make the comment that they're making decisive actions to protect the US economy and strengthen public confidence in the system. They have acted in a manner to ensure that depositors will have access to all of their money starting yesterday, our time, Monday the 13th of March. So there'll be no losses associated with the resolution of the Silicon Valley Bank that will be borne by the taxpayer. So they've also announced this, in this announcement, similar systemic risk exception, as they say, for the Signature Bank in New York. All depositors of this institution will be made whole. And as with the resolution of the Silicon Valley Bank, no losses will be borne by the taxpayer. So they finished their statement by saying the US banking system remains resilient and on a solid foundation, in large part due to reforms that were made after the financial crisis, the GFC, in the 2008-9 time. And at that time, they ensured better safeguards for the banking industry. So as far as they're concerned, they've stepped in, they've ensured that no innocent party will suffer direct loss from these couple of bank failures, and they've acted to steady the system as a result as well. Now that, of course, means a little bit maybe to some market participants, but of course it creates volatility, uncertainty, and already we've seen in the last couple of days the share markets drop off. And you know, that's another, we've seen year after year, time after time, that short-term volatility exists, and it's caused by all sorts of different reasons. And I'd expect that this volatility, again, is short-term. I suspect it will present good buying opportunities for longer-term investors, and such as the managers who look after your money here under our watch. And I think that, like I said, we'll see this as some blips along the way, and we'll return to a steady path in the normal manner in due course. The other thing I think is really quite interesting, and it flows on from themes of the past 12 months or more, and that is that it's not just share markets that suffer this kind of volatility from events that happen within the economy. So what we're seeing as well is that in the bond markets, those more affected by interest rate movements, and there's been a volatile year, as we've seen, for government bonds, corporate bonds, those kinds of normally defensive investments. And where we've seen interest rates rising, as we know, due to inflation and whatnot, already we're seeing predictions of cuts in interest rates now. So PIMCO sent out a note this morning that's where they observe that as far as even Australian cash rates go, the market's now pricing in only an 11% chance of a cash rate increase again next month. So that's interesting. It shows an immediate ability or willingness to respond to what goes on, and it'll be interesting to see how that plays out. Again, I'll tie it back to what it means for us and our approach, and that is that we look to be well placed regardless of what happens. It doesn't mean you can avoid drops. Of course they happen, but what we want to avoid is being forced to sell at the wrong time, whether that's share markets or bond markets. So it'll be interesting to see how it plays out. It also reinforces something that we talk about a bit with people, and that is that even in the defensive component, where those bonds lie, we have diversification in that, like we have in shares with global and Australian and property and infrastructure and small company and emerging market exposures. In the defensive section, we can also have fixed and floating rate bonds, longer duration bonds, and these react differently to different circumstances and different outside pressures. So I hope that made sense. That's probably where I'll leave it. If you have any queries, please do get in touch, of course. That's what we're here for. And other than that, I'll wish you a good day and a great week, and we'll catch up soon. Take care.